You know, when you look up at a massive new skyscraper downtown, the glass, the steel beams, the poured concrete, your brain immediately just registers physical reality.
Oh, absolutely. I mean, we're biologically wired to trust things that cast a shadow, right?
Yeah, exactly.
A huge commercial tower gives you this sense of absolute finality. You can literally walk up and touch the facade.
Right. But if you step into the reality of global finance, that physical building completely vanishes.
It really does. It becomes something else entirely.
What is exactly what we're getting into today. Welcome to today's deep dive. We are unpacking Will and Tate's book, Capital Markets and Real Estate. And his core premise is that the physical skyscraper is basically a financial illusion.
A highly engineered illusion, yeah.
Right? Like what you're actually looking at is a frozen stack of flowing capital. And our mission today is to demystify how this abstract, lightning-fast world of global finance intersects with the concrete, super slow world of bricks and mortar. Because whether you're an investor or just wondering why a new high-rise is going up in your neighborhood, this dynamic affects you.
It really is the intersection of two totally contradictory environments. I mean, capital markets are the definition of frictionless velocity.
Right. Billions moving in milliseconds.
Exactly. We're talking global bond and equity markets shifting across borders instantly. But real estate, conversely, is the ultimate friction. It's slow, it's highly regulated, physically immobile, and, famously illiquid.
Okay, so let's unpack this with an analogy. Is it accurate to picture capital markets as this massive, fast-flowing river of water and real estate as the physical farmland?
I like that, yeah.
Because the farm desperately needs that water to grow crops, but the water needs a farmland to actually produce something of tangible value.
Yes, to produce an inflation-hedged yield. That's the perfect way to look at it.
But here's where I want to push back. If real estate is so hard to buy and sell quickly, how does that fast-flowing river not just violently crash into the dam? Like if I'm managing a multi-billion-dollar portfolio, locking up my money in concrete for a decade seems like a total non-starter.
Well, that's where the magic happens. It doesn't crash because of a mechanism called liquidity transformation.
Liquidity transformation.
Right. The financial system figured out decades ago that you can't just marry a highly liquid market with an illiquid asset without some serious structural engineering.
So what do?
They securitize the income stream of the property. Instruments like real estate investment trusts or REITs completely change the dynamic.
Oh, I see. Because with a REIT, you aren't actually buying the physical elevator shafts or the lobby.
Exactly. You are buying a tradable digital share of the corporate entity that owns those assets.
Which suddenly makes it liquid.
Precisely. And a key part of a REIT is its legal structure. To qualify as a REIT and avoid corporate income tax, which is huge, the entity is legally mandated to distribute at least 90% of its taxable income to shareholders.
Oh, wow. 90% goes straight to dividends.
Yeah. So as an investor, you're capturing the underlying stability of the physical asset's rent roll, but you maintain the liquidity you need. If you want to exit your position, you don't have to spend 6 months finding a buyer for a 30-story tower.
You just sell your shares on an exchange on a Tuesday morning.
Exactly.
It effectively bottles the water from the farm so you can trade it instantly. That makes so much sense. But when developers are actually pulling that capital from the river to build, say, a massive mixed-use development, they're essentially constructing a capital stack, right?
Right. They're layering different financial instruments, debt and equity, to fund the project.
And this is where it gets really interesting to me. With equity, you're sharing the pie. But with debt, you're basically just renting the oven.
That is a great analogy.
But why would a massive developer choose the strict, rigid timeline of a bond over the flexible, shared risk partnership of private equity? Like, if a recession hits, bondholders still demand their payments.
They do?
So why not bring in a private equity firm to share that downside risk?
What's fascinating here is that it ultimately comes down to calculating the cost of capital and preserving control.
Control over the project.
Yeah. A private equity partner taking an ownership stake isn't giving you money for a safe 5% return. They might demand a 20% return because they're absorbing that shared risk.
Right. They want a huge slice of the pie.
Exactly. And they also usually want a seat at the table regarding, structural decisions, leasing strategies, when to sell.
So by utilizing debt, you are effectively renting the cheaper capital.
Yes. While a senior mortgage is a hard liability, it is significantly cheaper capital. The developer uses that cheaper debt to maximize their return on equity.
So if the building appreciates, the bank doesn't get any of that new value.
Nope. The developer captures the entire upside.
But developers rarely fund a $100 million project with just one senior loan and their own cash, do they? I mean, they use mezzanine financing.
They do, yeah, to bridge the gap. Mezzanine debt is fascinating because of where it sits in that capital stack we mentioned.
How so?
Well, let's say a senior lender is only willing to provide 60% of the project's cost, and the developer only has 15% in liquid cash.
Okay, so that leaves a 25% gap.
Right. Mezzanine debt slides right into that gap. It carries a much higher interest rate, but here's the crucial mechanism. It's rarely secured by the physical property itself.
Because the senior lender already holds the first lien on the real estate.
Exactly. So the mezzanine lender secures their loan with an equity interest in the developer's corporate entity.
Oh, wow. So it's tied to the company, not the building.
Right. If the developer defaults, the mezzanine lender can execute a rapid legal process to just take over the company that owns the property.
Basically wiping out the developer's equity entirely.
Yes. It is highly leveraged and highly punitive if things go wrong. But it allows developers to build massive projects without diluting their own ownership by bringing in outside equity partners.
It's a total high-wire act. You're layering these tranches of capital, hoping the market doesn't turn before the building is fully leased.
It absolutely is a balancing act.
So let's shift focus to the actual entities supplying these massive capital stacks. Because we're talking about institutional giants moving tens of billions of dollars, sovereign wealth funds, massive pension funds.
Yeah, and the underlying liabilities of those institutions actually dictate what gets built in your city.
Wait, really? How does a pension fund dictate the skyline?
Well, think about a pension fund's mandate. Their entire goal is to meet payout liabilities for retirees 20 or 30 years in the future.
Right, they need steady money.
Exactly. They require long-duration, highly reliable cash flows. That mandate naturally drives their capital towards stabilized Class A office parks or huge multifamily housing developments.
Because the rent checks are predictable.
Yes. Whereas life insurance companies, for example, operate similarly but might face sudden massive payout events, so they require slightly more liquidity in their real estate portfolios.
But a pension fund managing $200 billion can't just go around buying individual mortgages on strip malls. The paperwork alone would be insane.
It would be impossible. And this is where the true alchemy of securitization comes into play. They utilize a structure called a special purpose vehicle, or SPV.
Okay, let's visualize this SPV as a massive industrial blender.
A blender. Okay, I follow.
So an originator, like a massive global bank, takes thousands of individual cumbersome commercial mortgages. They dump all of those apples into the SPV blender and hit puree.
Right.
And what comes out is a smooth, easily tradable commercial mortgage-backed security or CMBS smoothie.
That is a remarkably accurate analogy.
But what actually is an SPV legally? How does a blender protect the pension fund buying this smoothie?
The legal architecture of an SPV is basically what makes modern finance possible. It is a completely separate, distinct legal entity created solely to hold those underlying loans.
Okay.
It is designed specifically to be bankruptcy remote.
Meaning if the originating bank goes under, the assets are safe.
Exactly. If the global bank that originated those thousands of mortgages goes completely insolvent tomorrow, their creditors cannot touch the assets inside the SPV.
Oh, that's wild. So it's legally walled off.
Yes, ring-fenced. The cash flows generated by the real estate are legally protected for the investors holding the CMBS.
But the cash flow inside that SPV isn't just sold as one uniform product, right? It's sliced into tranches.
Right.
How does the math of those tranches actually work for different risk appetites?
The tranche system operates fundamentally like a financial waterfall. When the commercial tenants pay rent, the money flows into the SPV, and the senior tranche investors get paid first.
Because they sit at the top of the waterfall.
Exactly. Their risk of loss is incredibly low. If a few properties default, the senior investors still get paid. Consequently, they accept a much lower yield.
And the investors at the bottom of the waterfall.
They hold the junior or equity tranches. If mortgages start defaulting, the losses hit the bottom first. These junior investors act as the shock absorbers.
So they demand way higher yields to justify that exposure.
Exactly, because their capital gets wiped out first in a downturn.
Okay, hang on. This exact waterfall structure was basically the heart of the 2008 financial crisis.
It absolutely was.
Tate talks a lot about moral hazard in the book. If a bank knows they're just going to sell these loans to an SPV and clear the risk from their own balance sheet, what's stopping them from underwriting terrible loans?
Well,
But if they don't have to drink the toxic smoothie, why would they care if the borrower can repay the debt?
this raises an important question, and you've identified the exact structural flaw that triggered 2008. The total separation of origination from risk retention.
Right.
Originators were incentivized purely by volume. They generated massive fees without holding any long-term risk. But today, the landscape is dictated by a much stricter regulatory framework.
Like what?
Well, post-crisis rules like Dodd-Frank in the U.S. introduced mandatory risk retention. It's often called having skin in the game.
They actually force the bank to hold on to a piece of the risk.
Yes. They're generally legally mandated to retain a minimum percentage, often around 5% of the credit risk. And crucially, they have to hold it in the junior tranche.
Oh, wow. So they are forced to act as the primary shock absorber for their own bad underwriting.
Exactly. It dramatically shifts the incentive structure.
But investors aren't just trusting government regulations now, are they?
Not at all. Prior to 2008, institutions heavily relied on credit rating agencies to tell them a tranche was safe.
Right, the AAA ratings.
Yeah. But today, investor due diligence involves massive data analytics. They use software to analyze the specific metrics of the thousands of individual properties inside the pool. They verify the health of the underlying asset themselves.
Because these giants operate globally, so they are hypersensitive to macroeconomic winds. The cost of capital, specifically interest rates, is the lever that controls this massive river.
Absolutely. A shift of just 50 basis points from a central bank can fundamentally alter capitalization rates.
Which determines whether a billion-dollar development gets built or just abandoned.
Right. Capitalization rates, or cap rates, are simply the expected rate of return on a property. When central banks raise interest rates, borrowing gets more expensive.
So investors demand higher cap rates to justify the risk.
Exactly, compared to a risk-free government bond. And that dynamic compresses property values globally. Because capital is borderless, it's constantly seeking the most efficient, risk-adjusted returns across different geographies.
Right. Tate illustrates this with the example of North American pension funds putting massive capital into e-commerce logistics hubs in Southeast Asia.
Yes, attempting to capture higher growth yields than they can find back home.
But here's the core contradiction. Real estate is inherently bordered. It's fiercely local. It relies on hyper-local zoning laws and neighborhood politics.
It really does.
So if a Canadian pension fund drops $500 million into Jakarta, how do they navigate that local friction without just failing?
Well, they cannot navigate it alone. Global capital requires deep integration with local operational expertise.
So they partner up.
Right. They structure complex joint ventures. The global institution provides the vast liquidity, and the local partner provides the operational alpha. They understand the zoning variances, the permits, the cultural nuances.
But beyond the physical friction, the financial friction of crossing borders is huge, like currency risk.
Oh, it's massive.
If that Canadian fund invests in Asia, the physical asset generates rent in a local currency. If that local currency depreciates by 15% against the Canadian dollar over 10 years, their entire yield gets wiped out before the money even crosses the border.
Which is why cross-border real estate relies so heavily on currency hedging.
How does that work?
Global investors use financial instruments like forward contracts or cross-currency swaps to essentially lock in exchange rates for their future cash flows.
So they're not just managing a building, they're trading foreign exchange markets.
Exactly. It adds a highly complex layer of financial engineering to ensure a successful building isn't destroyed by currency devaluation.
It is a phenomenal amount of invisible engineering. And managing that physical asset over decades brings us to how the industry is evolving for future risks.
Yes.
There's a huge shift toward ESG, environmental, social, and governance criteria. And Tate points out this is way beyond corporate virtue signaling now.
Oh, completely. It has become a pure risk mitigation strategy. Institutional capital sees that as global carbon regulations tighten, non-compliant buildings face massive retrofitting costs or huge fines.
Right. A highly polluting office building risks becoming a stranded asset.
Exactly.
Meaning an asset that major players just refuse to buy or finance because the environmental liability is too high.
Precisely. So investing in green infrastructure, advanced water recycling, solar facades, optimized HVAC, is fundamentally about preserving the exit liquidity of the asset.
If you want to sell a tower in 2035, it has to meet the standards of the funds buying it.
You hit the nail on the head.
And it isn't just the E in ESG. The S and G are dictating capital flows, too, analyzing how a development impacts affordable housing or demanding transparent accounting.
Right. And to manage all this complexity, they're deploying prop tech, property technology.
AI and predictive algorithms.
Yeah, we're seeing software that optimizes energy loads in real time or predictive maintenance that identifies a failing elevator component before it even breaks.
It's revolutionizing the physical management. But the most disruptive technological shift Tate discusses is happening on the capital market side, tokenization via blockchain.
This is where things get really sci-fi.
Yeah. Instead of a massive fund owning a building, the asset is placed into a smart contract, which fractionalizes a $50 million property into millions of digital tokens. We are moving from having to buy the whole pizza to being able to seamlessly buy a single pepperoni on a digital ledger.
If we connect this to the bigger picture, in theory, tokenization solves the fundamental problem we discussed at the very beginning, illiquidity.
Right.
It theoretically allows retail investors around the globe to hold fractional equity in premium commercial real estate that was previously reserved for the ultra-wealthy.
But let's look at the reality right now. Is this just a tech buzzword? Kate mentions severe liquidity constraints and massive regulatory hurdles.
He does, and he's right.
If I tokenize a building and start selling digital shares, I am essentially issuing an unregistered security. The SEC isn't just going to allow uninhibited trading of skyscraper fractions without intense oversight. Is the everyday investor actually ready for this?
You are highlighting the critical bottleneck. The technology is vastly outpacing the regulatory framework. For this to work at institutional scale, it requires absolute regulatory clarity on property rights on a blockchain.
And robust secondary markets to actually provide that liquidity.
Exactly. Plus institutional-grade cybersecurity. It's not going to happen overnight.
The legal friction is just too high right now.
Yes. However, the underlying structural pressure to securitize, fractionalize, and trade assets more efficiently is relentless.
It's coming eventually.
While regulations are catching up, the digital transformation of real estate ownership is structurally inevitable.
It is that invisible river of capital relentlessly carving out a more efficient path. To pull this all together for you, we started with the contrast between the physical permanence of a skyscraper and the frictionless nature of capital markets.
Right. And we explored how liquidity transformation bridges that gap through REITs and CMBS.
Ensuring the river doesn't crash into the dam. We examined how developers meticulously layer debt and equity to balance risk against control. We looked at SPVs, the moral hazard of 2008, currency hedging, and finally, how ESG and tokenization are rewriting the rules of the game.
It is arguably the most complex economic ecosystem on Earth.
Yeah.
And building on that final idea of tokenization, there's a profound question to consider.
What's that?
If the regulatory hurdles are eventually cleared, and the technology allows anyone anywhere to own a $50 digital fraction of the local skyscraper, how will that change our psychological relationship with ownership?
Oh, wow.
When citizens literally hold tradable equity in their own skyline, does it bridge the gap between resident and institutional shareholder? Does it change the civic pride we feel for the cities we live in?
It completely blurs the line between community pride and financial incentive. That is a phenomenal point. Keep wrestling with these concepts. The next time you walk downtown and look up at a massive crane hovering over new development, don't just see the concrete. Look for the invisible river of global capital, the complex financial engineering, and the highly calculated risk that willed it into existence. Thanks for joining us on this deep dive, and we'll catch you next time.